My friends, throughout my career, I've witnessed markets transform in ways unimaginable to my generation. Yet amidst this change, certain principles remain eternal. Today, I want to share the framework for what I call the Unbreakable Portfolio, not merely a collection of assets, but a psychological fortress built to withstand the timeless storms of human emotion. The fundamental error most investors commit is approaching the markets as a mathematical puzzle to be solved, when in reality, it's an emotional landscape to be navigated. Your greatest adversary isn't market volatility or economic uncertainty. It's the reflection you see in the mirror each morning. Let me be clear. The intelligent investor isn't the one who predicts the future correctly, but the one who builds a portfolio that survives being wrong. This distinction separates the professional from the amateur, the durable from the fragile. We begin with what I've always called margin of safety, though I'd like to expand this concept beyond mere financial calculations. True margin of safety encompasses psychological buffers, temporal flexibility, and emotional resilience. It's the difference between building a house that merely stands in good weather versus one that withstands hurricanes. Consider three emotional constants that have governed markets since their inception: greed during prosperity, fear during adversity, and impatience during stagnation. Your portfolio must be architecturally designed to manage these three states, because they represent the complete emotional cycle of every market participant. The first pillar of unbreakable investing is what I term emotional diversification. This isn't about spreading your capital across different stocks, but spreading your psychological risk across different time horizons and emotional triggers. Most portfolios are diversified by asset class but remain completely vulnerable to single emotional shocks. Here's a practical application. Allocate portions of your portfolio to different emotional time horizons. Some investments for immediate liquidity needs, others for 5-year goals, and a significant portion for what I call generational assets, investments you fundamentally believe in regardless of market conditions. This temporal diversification prevents the panic that comes from needing all your money at exactly the wrong market moment. The second pillar involves what I've learned about market psychology. There's a phenomenon I observed decades ago that remains truer today than ever. Markets tend to reward patience and punish impulsiveness. The challenge is that modern technology has compressed time horizons to such a degree that patience feels like inaction and impulsiveness feels like engagement. Let me share a principle I developed in the 1930s that still holds. The market is a voting machine in the short term, but a weighing machine in the long term. The unbreakable investor understands that while daily price fluctuations represent popular opinion, long-term value represents actual business performance. Your portfolio should be structured to benefit from this reality rather than fight it. This leads me to a critical distinction between price and value. Price is what you pay, value is what you get. In an era of instant information and algorithmic trading, prices can diverge dramatically from underlying value for extended periods. The unbreakable portfolio is built to not only survive these divergences, but to profit from them. The psychological challenge here is what I call narrative dominance, when compelling stories override fundamental analysis. We saw this with railroad stocks in the 19th century, radio stocks in the 1920s, internet stocks in the 1990s, and we'll see it again with whatever technology captures the public's imagination next. The unbreakable investor recognizes compelling narratives but never confuses them with investment fundamentals. Now, let's discuss practical implementation. How does one actually construct this psychologically resilient portfolio? It begins with what I term the core satellite approach, though I'm adapting this concept for modern conditions. Your core holdings should be businesses you understand deeply, with durable competitive advantages, purchased at reasonable prices. These are your foundation, the bedrock that allows you to sleep well regardless of market conditions. The satellite portion, which should represent a smaller percentage of your portfolio, can include more speculative opportunities. But here's the crucial psychological insight. The purpose of satellite investments isn't primarily financial, it's emotional. It gives your speculative instincts a controlled outlet while protecting your core from reckless behavior. This structure acknowledges a fundamental truth about investor psychology. Complete abstinence from speculation is as unsustainable for most investors as complete abstinence from rich foods for most dieters. Better to allocate a small, controlled portion than to risk your entire portfolio on impulsive speculation. Another key element is what I call decision pre-commitment. The unbreakable investor makes most important decisions before emotional situations arise. You determine your selling criteria, your buying thresholds, and your risk parameters during moments of calm reflection. Then you adhere to these predetermined rules during emotional storms. This approach directly counters what behavioral psychologists now call emotional contagion, the tendency to absorb and act upon the prevailing emotional mood of the market crowd. When fear dominates, it feels prudent to sell. When greed dominates, it feels foolish not to buy. Pre-committed decisions act as an anchor against these emotional tides. Let me share an example from my own experience. During the Great Depression, I established rules for myself about maximum position sizes and minimum quality standards. When particularly compelling opportunities arose that violated these rules, I initially struggled with the temptation to make exceptions, but I learned that the rules weren't constraints on my opportunity. They were protections against my own behavioral weaknesses. This brings us to the third pillar, continuous self-education. The unbreakable investor understands that while investment principles remain constant, their application evolves. You must continually educate yourself not just about businesses and markets, but about your own psychological tendencies. Keep what I call an investment journal, not just recording what you bought and sold, but why you made those decisions, what emotions you felt, and how those decisions ultimately turned out. Over time, you'll identify your personal behavioral patterns. Perhaps you're prone to selling winners too early, or holding losers too long, or becoming overconfident during winning streaks. The goal isn't to eliminate these tendencies, that's likely impossible, but to build portfolio structures that compensate for them. If you know you're prone to overconfidence after successes, you might establish rules that prevent increasing position sizes during winning periods. If you tend toward excessive caution, you might. Now, let's address a question I'm often asked. How does one balance conviction with flexibility? The unbreakable investor maintains strong convictions about principles, but remains flexible about specific investments. This is what separates dogma from wisdom. I learned this lesson profoundly in the late 1930s. I had developed certain criteria for evaluating railroad bonds, what I considered unshakable principles based on decades of experience. Yet the world had changed in ways that made some of these principles less relevant. The wise investor recognizes when the environment has fundamentally shifted versus when markets are merely experiencing temporary volatility. This brings me to perhaps the most challenging psychological concept, the balance between consistency and adaptability. Consistency in your fundamental approach provides stability and prevents reactive decision-making. Adaptability allows you to evolve when circumstances genuinely change. The art lies in distinguishing between market noise and genuine paradigm shifts. Let me illustrate with a principle I've taught for decades: the importance of buying assets below their intrinsic value. This principle remains eternal. However, how we calculate intrinsic value must evolve with changing economic realities. A manufacturing business in the 1950s required different valuation metrics than a technology business today. The principle persists. The application adapts. Another crucial element of the Unbreakable Portfolio is what I term liquidity stratification. Most investors consider liquidity in binary terms. Either an investment is liquid or it isn't. The psychological reality is more nuanced. You need different levels of liquidity for different emotional scenarios. I recommend structuring your portfolio with what I call emotional liquidity tiers. The first tier consists of cash and cash equivalents sufficient for both personal emergencies and investment opportunities. This tier provides psychological comfort during market downturns when others are forced sellers. The second tier contains highly liquid investments you can sell without significant price impact. The third tier comprises less liquid assets you consider long-term holdings. This stratified approach prevents the panic that arises when investors need to sell illiquid assets during unfavorable market conditions. Now let's discuss a behavioral pattern I've observed across generations: the tendency to extrapolate recent experience indefinitely into the future. During prosperous periods, investors assume good times will continue forever. During difficult periods, they assume recovery will never come. The unbreakable investor recognizes this pattern and builds portfolios that counter its effects. One practical method is maintaining what I call contrarian reserves, keeping a portion of your portfolio available to invest when others are fearful. This requires tremendous psychological discipline, as buying during market pessimism feels counterintuitive and uncomfortable. Yet history shows these are often the most profitable opportunities. The psychological challenge here is what behavioral researchers now call recency bias, the tendency to weigh recent experiences more heavily than distant ones. The 2008 financial crisis felt like it would never end while we were in it, just as the 1990s bull market felt like it would continue indefinitely. Your portfolio structure should help you overcome this natural bias. This leads me to discuss the role of what I've always called Mr. Market, my allegorical representation of market psychology. Mr. Market is your emotionally unstable business partner who offers to buy your share or sell you his every day. Some days he's euphoric and offers high prices. Other days he's depressed and offers low prices. The unbreakable investor understands that Mr. Market exists to serve you, not to guide you. You should take advantage of his emotional extremes rather than absorb them. When he's euphoric, consider selling him assets at premium prices. When he's depressed, consider buying from him at discount prices. The modern iteration of Mr. Market operates at lightning speed through digital platforms and algorithmic trading, but his essential nature remains unchanged. He still swings between irrational exuberance and unjustified pessimism. Your advantage lies in recognizing these swings for what they are: emotional extremes rather than fundamental shifts. Another key component of psychological resilience is what I term process orientation. Most investors focus overwhelmingly on outcomes. Did a particular investment make money? The unbreakable investor focuses primarily on process. Was the decision sound based on available information? This distinction is crucial because good processes can lead to bad outcomes in the short term, just as bad processes can lead to good outcomes through luck. If you judge yourself solely on outcomes, you'll abandon sound approaches during inevitable periods of underperformance. I recommend what I call the decision audit, regularly reviewing your investment decisions based on the quality of the process rather than the outcome. Did you conduct thorough research? Did you apply appropriate valuation methods? Did you maintain proper diversification? If the process was sound, the outcome will likely be favorable over time, even if specific decisions don't pan out as hoped. This process orientation provides psychological stability during periods when sound decisions temporarily produce poor results. It prevents the destructive pattern of abandoning proven methods simply because they haven't worked recently. Let's now address the psychological challenge of information overload. In my era, investors struggled with insufficient information. Today's investors face the opposite problem: overwhelming information flow, much of it contradictory or irrelevant. The unbreakable investor develops what I call information filters, systematic ways to distinguish signal from noise. This isn't about ignoring information, but about prioritizing what truly matters to long-term value. I suggest focusing on 3 categories of information: fundamental business performance, valuation metrics, and broader economic conditions. Within these categories, identify the specific metrics that genuinely drive long-term value for your particular investments. Ignore the rest. The psychological benefit of this approach is that it reduces decision paralysis. When you have clear criteria for what matters, you can ignore the daily noise that causes less disciplined investors to make impulsive decisions. Now, I want to discuss a concept that's become increasingly important in modern markets: the psychology of technological change. Every generation believes its technological innovations are unprecedented and will permanently transform investing. The automobile, the radio, the computer, the internet, each was hailed as revolutionary. The psychological danger arises when investors confuse technological sophistication with investment wisdom. Complex algorithms and high-frequency trading may create the illusion of advantage, but they don't alter the basic mathematics of value investing. This brings me to my final point for today: the importance of what I call psychological position sizing. Most investors determine position size based solely on financial considerations. How much capital to allocate to a particular investment? The unbreakable investor also considers psychological factors. If an investment's volatility will cause you sleepless nights, the position is too large regardless of its financial merits. If you find yourself checking prices compulsively, the position has exceeded your psychological comfort zone. I've always believed that the optimal position size is the largest amount you can invest without the position's fluctuations dominating your emotional state. This varies for each investor based on temperament, experience, and financial circumstances. The beautiful aspect of this approach is that it aligns your portfolio structure with your psychological makeup. Rather than fighting your natural tendencies, you build a portfolio that accommodates them while still adhering to sound investment principles. In our next discussion, I'll share specific techniques for identifying your psychological risk tolerance and building a portfolio that matches it perfectly. We'll explore case studies from different market environments and develop practical tools for maintaining discipline during emotional extremes. Remember, the goal isn't to eliminate emotion from investing. That's neither possible nor desirable. The goal is to build a portfolio structure that transforms emotional challenges into strategic advantages. The unbreakable investor doesn't avoid emotional storms. They build ships that can weather any storm. The market will always test your psychological resilience. The question isn't whether you'll face these tests, but whether you've built a portfolio and a mindset capable of passing them